This is another episode of me documenting the day-to-day process that I am taking to achieve long-term consistency in the financial market. And this is another weekly review brought to you by Lucas Flores, 8-Figure Day Trader, or simply the best, literally the best. I'm just kidding, guys. I'm a humble man. I'm getting there, but I definitely aspire to be a really good trader. So this is my second week on the eval. This is my second week that I'm also profitable. And if we look at the P&L over time, the accounts that I've been trading, we can see that I guess you could say I'm still in a break-even phase if we look at the daily net cumulative P&L. But I know that I'm well on my way out of this break-even phase. For the last 3 months, I've been break-even. I'm not even a losing trader anymore, and I kind of realized that the other day. For the last 3 months, I've been break-even. I haven't even been losing. So in August, took a heavy hit, took a lot of drawdown, but now, ever since I started the eval, and I've implemented a partial profit taking system, I'm able to work my way out of that drawdown. But the focus for this video is this week. So this week, what happened? Well, I was slightly profitable, barely profitable, at a win rate of 25%, profit factor of 1.64, and a day win of 33.33%. But look at my average win to loss. This is what's keeping me afloat, and this is the basis for the success of my model. It is a low strike rate, high RR model, which is why you're going to see my win rate is low. But if you look at my average win to loss, it's 5.3. That's very high. One thing I do want to note, though, is that the equity high that I made this week in comparison to last week was only a couple $100, which is something that I am trying to be aware of or mindful of. Because if we look at the P&L, the equity high from last week was $319, and the equity high after this week is $476.82. Now, why is that? It's because I'm incurring these periods of drawdown between my winning trades, because it's a low strike rate model, right? But it's high R. So I have to keep my losses as minimal as possible and find a way to stop stacking these 2R days, down 2R days, where I'm taking 2 losing trades in one trading day, like what I did all last August, down 2R, down 2R, down 2R, down 2R, down 2R, right? I have to find a way out of this hole that I keep digging myself into between the winning trades that I do take, because I'm incurring way too much drawdown between each winning trade. If we go to my weekly review, go to my session recaps, that is basically what I highlighted as a red flag for my performance stats from this week, because I'm barely profitable. I'm only barely profitable because of the periods of drawdown that I incur between my losses. So that's what I noted. I said I barely made a new equity high from last week. I incur too much drawdown before I finally catch a solid setup. My R multiple is very low, so I'm barely profitable on the week. And I know there's a lot more I can do to minimize the drawdown between winning trades. But by the same token, there's also a lot I can do to maximize the winning trades that I take. For example, if we go to Thursday, yesterday's trade, there's a crucial mistake that I made on this that did not allow me to maximize the win. So what I did was I couldn't resist from watching the trade, so I botched another exit, leaving a lot of money on the table. I got out too early, talking myself out of it. So basically what I did was, let me pull up the recording from that session. So in this long, you can see that I was in the market long, right? And I was targeting 23,552.50. Now, why was I targeting that level? So if you go to my attachments, look at my screenshots, I was targeting Monday daily high. You can see 23,552.50. Because the market rallied up initially, primed buy side, it did not take that high, but it made it relatively equal, which means there's a creation of buy side liquidity, which means once the market trades down and removes sell side liquidity from the marketplace and the higher time frame narrative is bullish, I'm expecting the market to start pricing for that buy side liquidity that was created above this high, especially when we have a 10 o'clock red folder, and the first thing the market does is trade lower. Now I have algorithmic signatures indicating that the market is strong down here, which made me end up placing a buy limit order and getting filled long at the market. And I'm targeting Monday daily high. Now all I had to do on this trade was what I did initially, but I could not resist the urge to watch this trade and watch open profit, and I talked myself out of the setup. So you can see that the recording is cut short before I close the position, because what I did was I literally just put the risk on and I closed everything. I closed the charts. Once I locked in equity at first presentation right here, once I trimmed 2 out of 3 contracts there, that I'm about to do right here, I'm noting how it's trading up into first presentation. I didn't like how it spiked off consequent encroachment, so I trimmed 2 right there. Got my finger on the sell button. So I locked in equity there, and as soon as I do that, I'm moving the stop to break even. And for the runner, what I want to do, what I want to grow into, and I have to fight the urge to micromanage these trades, is literally just close the charts and be done for the day and come back at the end of the session when the market closes and see what the outcome of the trade was like. Because if I do that, then I'm able to maximize my wins. I'm able to catch these huge swings that my model allows me to catch. But if I come back to the chart like I did and keep watching these trades and micromanaging a swing that I'm trying to hold for an hour or even multiple hours at a time on the 1 minute time frame, what is that going to do? I'm going to look at all the details as to why I don't think that would play out and scare myself out of the position. Therefore, I'm not able to maximize that win. So that's why the recording is cut short before the final take profit is taken. But eventually where I ended up selling this position was at here before the market delivered that high, right? So you know that my take profit order was sitting above this high. It never got there, and I sold here. Although I was able to get, 30 more handles on the runner, all I had to do was literally had to do nothing. And I could have made another 30 handles on this position, then I would have made over 50 handles on the runner. So I made the same mistake last Wednesday. I was not able to maximize this winning trade either. And the amount that I made on the runner was basically equivalent to that of where I initially trimmed 2 out of 3 contracts. You can see where I took off there. Because what did I do? Well, I stuck around and I micromanaged the trade. I moved my stop loss up to this low, micromanaging the trade because I thought that if the market were to reach for, my objective was Thursday daily high. So I believe it was not that level. It was a level beyond that. Back here, I think. All right, let me just mark that real quick. So had I done nothing, right? Had I literally done nothing and done the same thing where I moved my stop loss to break even and just let the last contract ride, this would have delivered an additional 80 handles from where I initially trimmed 2/3 of the position. But because I'm micromanaging the trade, boost my stop loss here, get knocked out early, when really I should anticipate the market to rebalance this impulse swing that it made. I can't really expect a straight shot right to my objective. Anticipate the market to retrace on that range and offer a discount again before it makes the final push up into the objective that I'm looking for. So I botched the exit on that trade as well. I'm just not maximizing my winning trades. And on top of that, I'm incurring a lot of drawdown in between the periods of my winning trades. So that's an issue that I mentioned in this weekly review. One thing that I can do to minimize that drawdown, though, is really get in touch with the criteria of my playbooks and really know what the market has to show in order for me to take that setup. Because what I struggled with earlier this week, on Tuesday and Wednesday, why I have the market approach incorrect, I'm going to open up a new tab here so it's easier for me to navigate back to the weekly review. So if you look at the market approach section of my review, you can see that 2 out of 3 days I had the incorrect market approach. Why was I incorrect on those 2 out of 3 days? Well, on the second, on Tuesday, I anticipated my bearish discount gap opening setup because it worked on Friday, and I have a tendency to subconsciously hunt the same move that made me successfully recently. But this did not set up as that market. It did not offer this playbook's criteria, but I was hunting that anyways because that's what made me successful on Friday. And then on the third, I framed the bullish bias incorrect because I gave into my tendency to hunt the sell side low resistance liquidity run, basically making the same mistake where I'm hunting my playbook that is my most successful playbook because it tends to offer huge swings when it does deliver. But that's not what market criteria is actually telling me it's going to do. So I'm noting that I have a strong tendency to approach the market in favor moves that have made me successful in the past. And that is what held me back all last month. That is the main reason for incorrect market approaches last month. I have a strong tendency to frame the incorrect approach because I'm looking for a low resistance liquidity run. I have a strong tendency to hunt this playbook right here because when it delivers huge swings. Like, for example, this trade that I caught right here, 128 points in the NASDAQ, it was that playbook. If we go to the previous month, both these trades, it showed up on consecutive days, 67 points here, 51 points here. So now I'm subconsciously going into each trading day looking for that to play out, and that is the reason why I got the approach incorrect on Wednesday. And I got the approach incorrect on Tuesday because I had a killer trade on Friday, 6.65 R, my best R trade, literally ever. And I go into the following day looking for a move that is similar to that. So I'm noting that my market approach tends to be incorrect because I have a strong tendency to try to hunt the move that has made me successful in recent history, which is why I framed the market approach incorrect on Tuesday and Wednesday. That's the primary reason behind why those are red days. Now Thursday, what happens when I actually follow my process that leads to a good trading day, when I actually follow my market approach, when I actually reference the daily chart and think about how this daily candle should paint based on how yesterday's closed, what happens? I frame a solid market approach, I submit to that, and I trade in that direction, and I'm able to catch a good trade. And that's how it works. The only reason I was able to do that, though, is because I did the work of refining and defining my playbook criteria for the setup that I subconsciously tend to hunt. So that's going to be my bearish premium gap opening setup, the setup that I'm always subconsciously hunting. What did I do after Wednesday? After Wednesday, I noted this tendency, like I keep hunting this playbook, but it's not showing up and it's not delivering. And I kept making that mistake all last month. So what's going on? So what I did was I did the work of referencing, number one, my notes from an Umar Ashraf lecture about the stages of trader development. And I went back in here. I went back to basically step one about what it takes to develop a playbook. And the first step would be your market approach and understanding. How do you look at the market? What is the logic behind the concepts that you trade that explains why the market goes up or down? That logic is what goes into your playbook, and your playbook is built off of that logic. But in order to get an idea of what your playbook is in the first place, you discover an anomaly, which is just something that consistently repeats, and you've seen it so many times that it becomes an easy setup that you're comfortable with. So you have to understand the logic behind your playbooks. That's step two. Step three is actually understanding the playbook. How do you understand it? You have to back test it, spend time with it, and create rules. So what I went back and did was I created rules for that playbook that I tend to subconsciously hunt going into almost every single trading day. I mean, if I look at my report, check this out. If we go to reports, if we go to playbooks, look how many times I'm attempting this playbook in particular. I'm attempting this playbook more than any other playbook. The bearish premium gap opening setup. I'm attempting it more than any other playbook, which shows my tendency to go into almost every single trading day looking for this setup because it's what made me successful in the past, which is what I'm trying to explain here. But the second that I sat down and I defined rules for that playbook and went back through and studied all the examples that I have of it, all the examples that I have logged in my price action log here, here it is, right? So I went back, studied all the examples that I have logged of it, as well as examples that I don't have logged of it. And I came to the conclusion that this is the very specific criteria that the market presents when this playbook does unfold. It does these specific things all the time. So now I'm going back in to TradeZilla and I'm creating rules for that playbook. So now I have very specific rules that are established for this. This is the market criteria that it presents. This is the time that it's going to happen. This is the entry criteria that I need to see in order for that to happen. So now I know exactly how this sets up every single time. And as soon as I did that, I eliminated my tendency to hunt that playbook. So on Thursday, if you look at my daily note from Thursday, we can see that initially I thought the bias was not high probability because I was asking myself, does it want to complete the buy model and reach for Monday's high, or does it want to fade lower towards Wednesday daily low? Why would I think it would want to fade lower towards Wednesday daily low? Because I'm looking at the lows below the market price and I'm seeing how smooth they are. It's a smooth edge. And that is what's required of my bearish premium gap opening setup. The first thing that I want, the first thing that I need is a smooth edge in the pre-market or overnight session. We can see that that checks the box here, right? But the second thing that I need to see is I need the market to open at the high of day. And in this case, the market was not opening at the high of day, was it? So if it's not opening at the high of day, it's not meeting the criteria of my bearish premium gap opening setup. Therefore, I am not expecting the market to break lower right at 9:30 because that was what that setup offers. I know this day is not meeting the criteria for the market to break lower right at 9:30, so that is not what I'm looking for. Therefore, I know there's a 10 o'clock red folder, and I'm going to stay patient and wait until that comes out and not trade until after it comes out. So I made the adjustments from the mistakes that I made earlier on in the week very, very fast. I jumped on those mistakes, and that is what allowed me to be successful on Thursday at the end of the week. Go back to my weekly review. So how did I grow this week? I finally sat down to really define the criteria for bearish premium gap opening setup because I knew that that was the playbook that I attempted the most because it offers a huge low resistance liquidity run. And once I defined exactly what that is, I immediately eliminated my tendency to hunt the sell side low resistance liquidity run, what held me back last month and Wednesday, because I know very specific criteria has to be met for that move to happen. So if it's not there, I'm not going into 9:30 looking for a break lower. It's that simple. It's very important to know criteria for each playbook, but it's even more important to know what it is not. And I've instantly tripled my setup selection skills. But I was only able to do this because of the failure from Tuesday and Wednesday. So what I want to get at is every failure carries with it an equivalent static success. The only reason why I sat down and defined that playbook criteria is because of the loss that I took on Wednesday and Tuesday, noting that I'm still giving into that tendency to hunt the sell side low resistance liquidity run and correcting that mistake. And then as well as a mistake that I made on Tuesday. On Tuesday, the mistake from these trades was, like I said again, first of all, getting the market approach incorrect because I have the tendency to hunt moves that have made me successful in the near term. I made a switch to my entry model. I'm now looking for just a change in the state of delivery, just the formation of a bearish order block, where in this case, you see how the market trades up here, and then we have a down candle that overlaps it. As soon as this open price is violated by a large down close candle, that validates that as a bearish order block. So that would constitute a short entry for me, but this is not actually a bearish order block, and I didn't realize it was not actually a bearish order block until I sat down and studied what is a bearish order block. But the only reason that I sat down and studied this in the first place was because of these two back-to-back losses that I took on Tuesday where I stacked 2R. I got really tired, really frustrated with stacking 2R on my losing days, which as you can see, I hate the fact that I consistently stack 2R on red days. Right? So that motivates me to make some change. So what I did was I sat down and I figured out what actually makes a bearish order block. And in this case, order block criteria. In order for me to consider an order block as an entry, it must remove liquidity from the marketplace, meaning it goes above an old high or below an old low. And it must reference a PD array and indicate respect of it. It's not just going to overlap of a down candle when bullish or an up candle when bearish. So it's not just going to overlap up candles when I'm bearish. It has to remove liquidity from the marketplace or refer to a PD array, because what makes an order block is the context surrounding it. In this case, in this losing trade, what I was framing the loss or what I was framing the trade idea off of was a 15-minute sell side imbalance, buy side deficiency. If I go to the 15-minute time frame, you can see that small separation between this candle's low and that candle's high. That's the gap that I was framing the trade idea off of. On the 1 minute, this does not indicate respect of it. That 15-minute gap that I'm framing the trade off of is this gray shaded box right here. You can see that the 1 minute up close candles are literally trading up out of that. And if you look at where the bodies stop, it's right at the midpoint of that, right? So that actually tells me this is using this as an inversion level and not actually as a level of resistance. It's actually using this level as support. If we look at where the bodies stop on these two close, On the close of this candle here, on the open of this candle right here, where does it stop? Literally right at the open price. That tells me this is using this as inversion, as support. It does not indicate that the market is rejecting this. So this does not indicate that it's respecting does not indicate that it's respecting this premium array. Therefore, the sell idea there is never valid at all. So that's not a trade. Now here, this actually was not a terrible trade because I know this is a valid bearish order block because it references this premium array. You notice how it trades right up to that orange line, which is an order block on the higher time frame. Also the midpoint of that gray shaded area, which is an imbalance on the higher time frame, but it closed below it. This is a valid bearish order block and therefore it produces a move lower because it's in reference to a premium array and indicates the respect of it. This trades up into that last up close candle, and then we have a solid large down close candle that overlaps and violates the open price of the buy side delivery here. This I would consider a valid bearish order block because it's in reference to this valid bearish order block. This trade just did not work out, so it's not necessarily even a bad trade. But both trades I took at the market, and from the mistakes that I made last month, I set the intention to not enter at the market and only enter off of limit orders. So this is my first day trading the change in the state of delivery. This is my first day trading the order block. And as a result, I took some impulsive trades at the market, which is not ideal, but quickly corrected that mistake. I didn't make it again this week. Now, another huge change. It's probably the last detail that I'm going to touch for the weekly review. If we go back to the session reflection, how I held myself back early in the week. So if you look at the economic calendar, this is key, right? We had red folders every day at 10 o'clock this week, Tuesday through Thursday. We had 3 days in a row where we had a red folder at 10 o'clock. So what I've learned from messing up on back-to-back days where we had a 10 o'clock red folder, I went back and studied what does the market look like on days with a 10 o'clock red folder. And if I go to my price action log and I simply check all the days where there is a 10 o'clock red folder, like this, we can see that as I scroll through these examples, you're going to see one of two things. Either the move is going to happen right at 9:30, or it's going to come after the 10 o'clock red folder comes out. So check this out. This is a day with the 10 o'clock red folder. The move happens right at 9:30. Okay, here's the 10 o'clock red folder. We see a continuation of what happened at 9:30. So in this case, the move also happens right at 9:30. It just breaks lower right at 9:30. Just breaks lower right at 9:30. In this case, the move does not happen at 9:30. So the condition initially is extremely unfavorable, extremely high resistance. Once the 10 o'clock driver comes out, which is on, I think, probably one of these candles somewhere in here, then what happens? Then the market makes the real move of the day. With the inversion fair value gap and the price leg that removes liquidity from the marketplace, that is also a change in the state of delivery. It's also what I'm going to be using as a high probability entry on the 1 minute time frame, because it's also a change in the state of delivery. An inversion fair value gap is a change in the state of delivery. If we go to the 1 minute time frame, this is another day with a high impact driver at 10 o'clock. Guess what happens? It happens right at 9:30. This is a valid bearish order block because it's in reference to this premium array. Removes liquidity from the marketplace here. Indicates respect of the premium array. Notice how the body stopped right at the low of that higher time frame imbalance. And I can sell short these up close candles. In this case, it also happens right at 9:30. In this case, there's literally nothing to do. So either it's going to happen right at 9:30, or the market's going to be extremely unfavorable until the 10 o'clock driver comes out. In this case, it was extremely unfavorable the entire morning session. So what happens again? Happens right at 9:30. What happens here? Extremely unfavorable. So right away, I don't like days that have a 10 o'clock high impact driver. Unfavorable before the 10 o'clock driver, then the market manipulates lower, and that's not even the real move of the day. It's the fake move of the day. We see the real move in the PM session. This, I don't have any screenshots recorded. It happens right at 9:30. So it's the same thing that's repeating over and over again. I'm sure I don't have to show you more examples. But this was what happened on Thursday, where first we have unfavorable conditions, right? 10 o'clock driver comes out, then we see the boom of the day, then the market starts to get really fluid, really liquid. So sure, at that point, you can get the idea of what I'm trying to aim at. But early in the week, my unawareness of what sets up a move at 9:30 and 10 o'clock red folders held me back. Every day this week had a 10 o'clock red folder, and on 2 out of 3 days, I was hunting moves early into the opening, looking for a break lower. Really, I was giving into my tendency to hunt the sell side low resistance liquidity run and trying to jump onto that quick into the open, completely ignorant to how price behaves on days with 10 o'clock drivers. Once I made the adjustment on Thursday and knew to wait, I was able to catch a solid setup. Once I finally defined the exact criteria that the market presents every time there's a break lower at 9:30, that creates a sell side low resistance liquidity run. I was able to curb mistakes that I made earlier in the week and stay patient. I know that on days with the 10 o'clock red folder, the move is going to happen at 9:30 or it's going to happen after the driver. If price is not set up in the way where the move can happen at 9:30, I know to wait. I only know this because this is what stacked to drawdown Monday and Tuesday, which is why I'm telling you right now, your losses are not losses because you can extract value from them like this, literally like this. You're going to take your loss and you're going to grab it, you're going to go and you're going to extract a lesson from it, and you're going to use it to make you a better trader. Just like that. Literally exactly like that. Let's do it again. Like that. Got it? Good. So, I think I touched on basically everything. See if there's anything else from the weekly review that I should touch on. So now you know exactly what's been holding me back recently. Not maximizing my winning trades. Giving into my tendency to hunt a move that made me successful in the near term. Didn't know what made a valid bearish order block. Trading around 10 o'clock red folders. I learned so much this week in only 3 trading days. And I'm not trading today, Friday, because it's NFP Friday. Let's look at what the market's doing. I think we opened now. It's 9:35 Eastern Standard Time. So let's see what's going on. Okay. So this could actually be my premium gap opening setup. With a large gap up here, right? Open at the high day. First thing the market does is open, trade up, clear the high day, fail. Let's see what happens. It could come all the way back down to this low. You never know. It's NFP. It's 167 handle run up. The higher time frame narrative is bullish. Noting how there's barely any lower wick on that candle, and we have a new day opening gap that is inefficient because we gapped up from the previous day close. So I know that this portion of that new day opening gap is inefficient right there. Right? Just like that. So there's a reason for the market to want to draw back down here. Let's see if it can do it. I'm not trading today because I'm about to go out of town, and I'm already profitable on the week before NFP Friday, so I'm not going to go into NFP Friday, a day that is extremely dangerous and extremely volatile, and risk giving that back. I'm just going to be done. I'm just going to be, okay, I finished the week up by Thursday. I'm not trading NFP Friday. That's it. This is something that I would never have been able to do in the past. In the past, I would think I would absolutely have to trade NFP Friday no matter what and try to get a session in before I'm going out of town. I would literally do those things. I remember back in 2023, same situation. You know, I was going out of town literally that morning, and I still traded that day. I told myself, you know, I'm just going to go to the market and watch it. You know, let's just see what happens. Let's just see what happens. What happens? I end up putting risk on. I end up taking the losing trade. Now I have to go through my entire journaling process of reflecting on that losing trade, and it's just frustrating. So, don't do it, guys. You know when you should not be trading. Don't be fucking trading. I'm not trading because I have other things going on that could possibly influence how I feel when I'm trading. This could be a fine example of my bearish premium gap opening setup that delivers literally 200 fucking handles because it is NFP Friday. But I got things going on, and I'm already up before NFP Friday. I'm just going to end the week. I've already done my weekly review. I'm good, and I'm ready to go into next week and ready to win again. So that's how it is. That's going to be it for this one. I will talk to you on probably Tuesday because we got PPI and CPI next week. Monday is no driver, so I'm not trading. Tuesday is the day before PPI with no driver as well. I might not even trade till Wednesday. So that's it for this one. Talk to you maybe Tuesday or Wednesday.